Welcome to Paycheck for Life, Acera's new and mid-career employee webinar. So in this webinar, we're assuming that you're either new or you're somewhere in the middle of your career, which is why we named it the new and mid-career employee webinar. And the bottom line there is that you're not yet near retirement, which is a good thing because it means you still have plenty of time to plan for retirement. So in this webinar, I'm going to tell you all the things that you might want to know about doing that planning for retirement. And since you're curious enough about retirement planning to watch this, you probably have a few questions. Questions like, what do I need to know about my pension? Do I need to do anything? And if I need to do anything, what are the things that I need to do? I'm going to answer all those questions, and I've arranged the answers to the questions I think you're going to ask because I've been doing this for a while into the form of this checklist. And this is what I'm going to go through. These are the topics that I'm going to cover during the webinar. I'm going to help you understand a few retirement basics. And then we're going to talk a little bit about pension math. I'll show you our retirement formula and I'll talk about purchasing service credit. And if you don't like math or you think this is not what you signed up for, it's super simple. It's like this one multiplication, and I'll break it down for you. And the reason that I'm going to do that is because it will help you understand how you are earning your retirement now, so that it will help you dial in that retirement as you go through your career. Okay, then we're going to talk about getting a precision pension estimate from our website. I'm going to help you understand retirement eligibility, and that is when you actually become eligible to retire. And then I'll talk a little bit about additional benefits like healthcare benefits and death benefits. I will talk about designating your beneficiary or beneficiaries for those death benefits. I'm going to help you understand some career planning options. And what I mean by career planning options is that at some point, you're going to stop working at your job that you're currently working in. Whether you work a long career straight into retirement or whether you leave before that, what are your options regarding your membership with Acera? And then we'll talk about making a retirement planning picture. And what I mean by that is just taking a little time to get a little window, a little peek into your future and your future retirement income to make a few little adjustments now to kind of dial it in now, so that when you get to retirement, you will be set. And as part of that discussion, we'll talk about starting a 457B account. Okay, so let's jump right in. I see there's a question up on the board. Um, Somebody's asking if this is an hour long. Actually, this goes until, well, the Acera part goes until 11:15, so it's about 2 hours and 15 minutes. Then there's a 45-minute 457B presentation. The whole thing is about 3 hours. If that was confusing, if we have some erroneous information about it being only an hour on our website, I apologize for that. Um, it does seem like a long time, but in my view, I don't think it's pretty information packed, so I don't think it's going to be boring. So feel free to cut out whenever you need to. And like I said, we're going to videotape it and post it out on our website so that you could rewatch the parts that you missed later if you got to leave early. Okay, let me help you understand some retirement basics. So first of all, who is Acera? I like to say who is Acera because Acera is not just this acronym that stands for the Alameda County Employees Retirement Association. Acera is made up of a lot of people. There's about 93 of us that work here at Acera. We're county employees, so we're government workers like yourself. And our entire job is to provide retirement, disability, and death benefits to our members. That is you. You are members of Acera, and so you are part of the who that is Acera. And you're members of Acera because of the position that you work in and who you work for. So at some point, you either currently or at some point you worked full time in a retirement eligible position. And because you worked full time or you still work full time in that retirement eligible position, you entered Acera. You became an Acera member because you work for one of the six public employers. These are six public agencies in Alameda County that use Acera to provide retirement benefits to their employees. So you work for one of these places in that retirement eligible position, And as soon as you worked full time in that retirement eligible position, you became an Acera member. And I say that you maybe not, maybe you don't work full time anymore, because if you go down to part time, you retain your Acera membership and you keep earning more and more credit toward retirement. Okay, so as an Acera member, you contribute to Acera's fund with every paycheck. Okay, that's your employee contribution. It goes into Acera's fund. And if you look at your pay stub, this is an example of a county pay stub, and you look at the before tax deductions column, you'll see a line that says something like retirement, and you'll see some money coming out of your paycheck, each and every paycheck. That goes into, sorry, that goes into Acera's fund. And every time you make that contribution, your employer makes a contribution on your behalf. So then, what do we do with all that money? We don't just want it to sit around and collect dust. What we do with all the money is we invest it in a diverse array of investments all over the world, and we earn a lot of interest on that money. And so it's these three sources of income: your employee contributions, your employer's contributions, and earnings, the investment earnings that we make from investing all the money and keeping it invested, that give us this big pool of money that we call Acera's fund. Okay, so now, why are we doing this? Why are we collecting all this money? Why are we trying to earn interest on it? Okay, why are we maintaining this Acera fund? Well, the reason that we're doing that is because as you go through your career and you work in your career, you're earning more and more credit toward retirement in Acera's retirement system. You're earning credit in three different categories, which I'll show you in just a minute, okay? So as you work, you earn more and more credit throughout your entire career, throughout your entire membership with Acera. And then at some point in the future, the goal is that you will stop earning credit toward retirement and you'll leave your job and you will retire. And at that point, you start collecting the retirement that you earned throughout your career. And you're going to collect that retirement throughout that you earned in your career in the form of a retirement allowance that you're going to get every month for the rest of your life. You cannot outlive your retirement. It happens each and every month for the rest of your life. It's amazing. It's a it's a really special benefit. And you'll notice that I'm using this term retirement allowance, and I'll just give you a few more terms that I might throw around while we're going through the presentation that are synonyms for this same concept. Pension, pension benefit, pension allowance, retirement benefit. These are all synonyms for the same concept, that you are going to collect a monthly retirement allowance for the rest of your life based on the credit that you earned toward retirement while you were working. And I just like to point out at this point that pensions are really special because the way that they work, the way that this defined benefit pension plan works that is Acera, is that as you're going through that career, the credit that you're earning toward retirement is defined. You know how much you're earning, and because of that, you can get precision pension estimates to look into the future to know what to expect, um, what your retirement allowance is going to be. So it helps you do really precise retirement planning because it's a guaranteed benefit that you're going to get for the rest of your life. It's a paycheck for life. And another reason I like to point out that it's special is that all of those employee contributions that you paid into Acera, plus the interest that we have paid to your employee contribution account throughout your entire career, we're going to give you all that money back within your first 3 to 5 retired years. So the first 3 to 5 retired years that you're retired, you get all the money back that you paid in throughout your entire career. And then after that, it's almost like this magic bonus that you get to have a steady paycheck for life for the rest of your life, but not really, because that's how the whole system is built. Once we give you back all your money that you paid in, then we start paying out of the employer contribution and then the interest. And it's actually the interest that pays for 75% of your lifetime benefit. And that's just the way the system is built. And you get to participate in this amazing system. A lot of people don't get to participate in this. They're just saving money into a 401k, and that's a finite amount of money, and that could run out at some point. But your pension benefit from Acera cannot run out. Like I said, it's a lifetime monthly payment. Okay, so what I'm showing you right now is a pension milestone chart. This is a timeline that has some milestones on it that you will likely see during your membership with Acera. And I'm showing you this because it provides some context for some of the discussions that we're going to have later on about some of the details about Acera. So, and somebody asked, can you get a lump sum amount? Yes, you can. If you choose to do that, I'm going to try to talk you out of doing that in the second half of the presentation when we talk about career planning options. But that is your choice. That will be your choice. So we'll talk about that later. Okay, so the first milestone on the pension milestone chart is your date of hire into your full-time retirement eligible position. This is your first day of work in that position. For 4 of our employers, there's a 2-week lag. So 2 weeks goes by, and the first day of your second pay period is your date of entry into Acera. This is your first day of Acera membership. This is the day that you start earning that credit toward retirement. Now, for 2 of our employers, Livermore Area Recreation and Park District, and I believe the Housing Authority, there is no 2-week lag. Your date of hire into that full-time retirement eligible position is your date of entry into Acera. Okay, now you're an Acera member. You're earning credit toward retirement. What happens? Okay, so let's say that you work 5 years in your position and you earn 5 years of service credit with Acera. Essentially, what happens is as you work in your position, you earn more and more service credit with Acera. I'll talk more about service credit in a minute. But once you earn 5 years of service credit, whether you're working full time or something less than full time, maybe you work 4 full-time years and 2 half-time years, that would equal 5 years of service credit. Once you have earned the 5 years of service credit, you're considered vested in the retirement system. Investing, it's a little bit of a loose concept. It kind of means guaranteed. So when you're vested in the retirement system, you are guaranteed the vested benefits. You're basically guaranteed the guaranteed benefits. What it really means is that at 5 years, you start to be able to unlock the ability to collect some of the benefits that you've been earning. Okay, and I'll talk more about that later. You'll see what that means later. Now, the next pension milestone is your date that you first become eligible to retire. And the reason I have not defined how many years or what the age is because there's a few different combinations that will get you to retirement eligibility based on your years of service credit that you've been working and your age. We'll talk about that in the second half of the presentation, so it's going to be a little bit different for everyone, but this would be the first day that you are eligible to retire, and I think it'll probably be earlier than you think, okay? So, you can retire on this day if you want, but the vast majority of people do not because the longer you work, the more credit you earn toward retirement. And when you earn more credit toward retirement, your retirement allowance that you're going to collect in retirement goes up. And I'll show you that in a few minutes, how that works. So that's why I've left a gap here between these milestones. Okay, the next milestone is your last day of work, the date that you leave your employer. So this is known as your termination date or your last day on payroll. And many people will go straight from that into retirement if you're working a long career and you retire immediately. So that's why I haven't left a gap between these two dates, but that's not going to be the case for everyone. In some cases, there will be a gap between those two dates. Some people will stop working and defer their retirement to a later date, which is perfectly fine. And I'll show you that option under the career planning options section. So, but this is your last day on payroll. Okay, so now your first day of retirement is a date that you choose. You tell us when you want to retire, when you're ready. And this is the day that you start collecting the retirement that you earned throughout your entire career. And you're going to collect that retirement every month on the last business day of the month for the rest of your life until your death. And that's when your retirement payments stop. Now, you can see that there's one more milestone on the chart, which is because at the time of retirement, you have the opportunity to name a beneficiary, or in some cases, multiple beneficiaries, for a continuance, which is a death benefit and a continuant that goes to your beneficiary. And the continuance part, that word just means a continuing monthly payment that goes to your beneficiary. So in most cases, it will be for their lifetime. They'll get a monthly payment for the rest of their life after your death. And then when they die, that would conclude Acera paying out the benefits that we owe you and your beneficiaries. Okay. So I want to say two more things about vesting. One of the things is that I mentioned it happens at 5 years of service credit. It includes reciprocal service credit. Reciprocity is where you link multiple retirement systems in California together to garner some synergy between them. I will go into detail about reciprocity in the second half of the presentation when I talk about career planning options. But I just wanted to mention that it includes reciprocal service for those of you who already have reciprocity. And where does the guarantee come from? I said vesting means guaranteed. Where does that come from? It comes from the state law. State law governs everything that we do at Acera, tells us how to calculate retirement, tells us how to run everything. So your retirement is guaranteed by state law. And the guaranteed benefits, the vested benefits, are that retirement benefit for life, which, like I said, happens every month for the rest of your life when you retire. Also, a cost of living adjustment, which is a percentage increase every year to your retirement. And then there's a $1,000 lump sum death benefit that's considered vested. There are other death benefits that will go to your beneficiaries in certain situations. One of those would be, like I said, that monthly continuance for the rest of their life. Okay, so let me talk about your tier. You're all in one of these tiers. And it depends on when you entered Acera, your date of entry into Acera. So first off, to figure out which timeline to look at, if you're a safety member, you're going to look at the bottom timeline. So a safety member is a sheriff's deputy or a probation officer. There could be some other sworn officers that I'm not aware of. Okay. So that's a safety member. If you're not a safety member, you're a general member. So if you're not a sheriff's deputy or a probation officer, you're a general member. So you're looking at the top timeline unless you're a general member who works for the Housing Authority or you're a general member who works for Livermore Area Recreation and Parks District. Okay, so the way your tier works is if you enter Acera before the cutoff date for the tier, you go in the earlier tier. So if you entered Acera before July 1st, 1983, that would have put you in tier one. Since this is a new employee slash mid-career webinar, I'm assuming probably there is no tier one people here, but I could be wrong. If you entered Acera July 1st, 1983, all the way up to December 31st, 2012, that would have put you in tier two. And if you entered Acera January 1st, 2013 and beyond, that would put you in tier four in every case, so on every timeline. And the reason for that is because the state of California created tier four in 2012 to take effect January 1st, 2013, when they passed the Public Employees Pension Reform Act, which is also known as PEPRA. So you'll notice that the Housing Authority has a different cutoff for tier one. You'll notice that LERPD has no tier two. They have a tier three that they negotiated for their employees, and there's a different cutoff for tier one. And for the safety members, there's three tier twos. And if you entered Acera during this period, you had a choice between tier 2C and tier 2D that you had to make within 45 days of your Acera safety membership. And if you didn't make a decision, then you were defaulted into one of the tiers. In any case, to find your tier, if you're unsure, all you do is you log into your account on our website, which is, let me show you our website, acera.org. You click the login button right here, and it will take you over to Member Direct, which is our member portal for you. You log in here if you've already created your login, and you'll get right in there. It'll show you your tier and your date of entry. Now, if you've never created a Member Direct account, and you didn't take advantage of the PIN that we sent you in the mail back in November as a active employee, what you're going to have to do is click Enroll, and then you're going to have to request an enrollment PIN. And then you put in your info here, click Request PIN, and what we will do is send you your PIN in the mail for extra security purposes. So it'll take a few days to arrive. So you won't be able to get in immediately, but we'll get it out to you as fast as we possibly can. Okay, so now you know what tier you're in. Okay, let me check the questions here. Somebody says, how do you get the continuance beneficiary? I'll talk more about beneficiaries in the second half when I talk about death benefits. So yeah, don't worry about that. You'll be able to name beneficiaries even for a continuance as an active member using the advanced death ADB, Advanced Death Benefit Election. That's what it is. I'll show that to you in the second half of the presentation. And somebody asked who can be named as a beneficiary. Yeah, pretty much anyone you want can be named as a beneficiary. Spouses and children are popular people to name as beneficiaries, but it's the person that you name for your ACERA death benefits. And I will go into detail about that. Okay. So at this point, I want to show you this slide. I'm going to return to this topic later, but I wanted to give you some context for the overarching conversation that we're having. Because you're new and mid-career employees, so I really like to emphasize retirement income planning in this webinar. And so what financial planners will tell you is that in order to maintain your standard of living in retirement, that's way in the future, your retirement income should be at least 80% of your working salary. They call this income replacement. That's kind of a pension term. So because your retirement income should replace at least 80% of your working salary. So that, that might sound a little nerve-wracking right now, especially if you're new. How am I going to do that? How am I going to get there? How am I going to earn that much credit toward retirement? Well, it's actually, I think you'll find once we get to that discussion that it's actually fairly simple. But your retirement income is going to be from a combination of your ACERA monthly pension, Social Security, and any additional savings and investments. So what I'm going to do right now is talk a lot about the ACERA monthly pension, how to dial that in and maximize that. Then, sorry about that. Hang on one second. Then we'll get into the discussion of getting a Social Security estimate and dialing in extra savings and investments to get pointed in that 80% trajectory. So that's kind of our goal by the end is to talk through all of that stuff and get you pointed in that trajectory. So regarding our discussion about ACERA's pension, let's jump in and talk a little bit about understanding pension math. And like I said, in the table of contents section, don't worry. Like this is just a simple multiplication. I'm going to walk you through this. And the reason I'm telling you this right now, even though your retirement is much later in the future and you feel like maybe I don't need to know this right now, is because the way to maximize that monthly retirement allowance is to dial in each of these three factors in the retirement formula to maximize those. And so if I explain to you how each of those work right now, then you'll go through your career knowing how to maximize those three factors and maximize your monthly retirement allowance. Okay, so when you go to retire, this is the formula that ACERA is going to use to calculate your monthly retirement allowance. Essentially, what's happening in this multiplication is that you, as a future ACERA retiree, are going to get, as your monthly retirement allowance for life, you're going to get a percentage of your highest salary from any point in your career, the highest point in your career, for each individual year of service that you work, that you earn with ACERA. Okay, so essentially, what this sentence in English is describing is what is happening in this multiplication. You're going to get a percentage of your highest salary for each year of service. Let me plug in some numbers, and I think it will help illustrate this a lot easier, okay? So let's say, for the sake of an example, that the percentage of your highest salary that you're going to get for each year of service is 2%. Let's also take an example and add to this example that you worked by the time you retire in the future for exactly 20 years. You earned 20 years of service credit with ACERA, okay? So what we're going to do, what this means is that you're going to get 2% of your highest salary for each individual one of those 20 years of service. So one way to think about it is we take the 2% of your salary that you're going to get and we add it all up 20 times. That equals 40%. Essentially, we're doing a multiplication. So we're multiplying 2% times 20 years, 40%. So your retirement allowance in this example will be 40% of your highest average monthly salary. So to finish out the example, let's say your highest average monthly salary is $5,000 per month. 40% of $5,000 when we finish out the multiplication is $2,000. That becomes your retirement allowance that you'll receive every month for the rest of your life, plus cost of living increases. So you can see that because this is a multiplication, the higher any of these factors are, will equal a higher monthly retirement allowance for life. So the way to dial in this monthly retirement allowance is to dial in each one of these factors. So let me tell you in a little more detail how to do that, how we calculate each one of these, how to maximize them. Okay. And I see a couple of questions on the board. I'm going to address those right now. Okay, so let's talk about the age factor percentage first, since it's at the top of the equation. Now, I use 2% as an example, but it's not necessarily going to be that. And so I would ask, what percentage of your highest salary will you get for each year of service? And now I'll answer the question for you is that it's going to be based on your age at retirement. So this one, I like to say dialing in each of these factors. Really, this one, it's pretty easy to do, which is you just age. You just get older. The older you are, when you retire, the higher the age factor percentage is going to be that we're going to use in the formula for you. And it's based on this set of age factors that's in the state law that tells us, how to calculate your retirement. And so what you're going to do, and what you're seeing is a sample chart of some of those age factor percentages. And so for the example, what you're going to look at is find your tier, whether you're a general or safety member. Again, safety members are sheriff's deputies and probation officers. General members is everyone else. You look at your tier and just look at that column, okay, for right now. You forget about all the other columns because they never will apply to you. So let's say that you are a general tier 4 member and you retire at age 57. Well, we would come down here to the chart. We'd see age 57, general tier 4, those intersect at 1.50%, and that would be the percentage that you would get for each year of your salary for each year of service, okay? And so you'll note that the percentages get bigger the older you are when you retire, up to a maximum age factor percentage for your tier, which is denoted by the blue box. So if you retire at that age or older, you get the maximum age factor percentage. Okay. You'll also notice that I skipped a bunch of the ages. There's a bunch of gaps here in the chart, and that's because there's so many incremental increases they don't all fit on the slide because they increase every quarter year that you age based on your birthday. So if your birthday was January 15th, for example, one quarter after your birthday, you just add 3 months, April 15th, and July 15th, and October 15th. Every time you pass one of those, every time you age 3 months based on your birth date, there's actually an incremental increase in the chart. And so we will use a slightly higher age factor percentage. So when you finally get to retirement, far in the future, that's how we're going to determine your age factor percentage. And so that answers one of the questions up on the board. Somebody asked, why is tier 4 lower? Tier 4 is lower because that is because the state of California decided that they wanted to dial in people's retirement from the outside a little bit more closely back in 2012. So they created Tier 4. So everyone who entered ACERA January 1st, 2013 and beyond goes into Tier 4. And I think it's to ensure that, I think it's to their effort to, make pensions stronger or something. But you will note that with Tier 4, you can get a higher final percentage than Tier 2. You just have to wait a couple more years. Okay. And then somebody's asking, my boss is retiring at 75. What's the percentage? Well, the percentage would be, if they were in Tier 2, it would be 2.43%, because if you retire older than the maximum age for where you get the maximum percentage in your tier, you just get whatever the maximum is. So the age factor percentages stop increasing at that maximum age. And then somebody's asking, does this mean that for tier 2, you cannot retire before 50 years old, regardless of years of service? Actually, no. And I think you'll find that out when we get to the retirement eligibility slide, which I'll get to in a little bit. There is a scenario where you could retire younger than age 50 with tier 2. Okay, so that's the age factor percentage. I gave you a lot of details. The bottom line there is, if you don't want to remember all that stuff, the older retirement age equals a higher age factor percentage up to the max for your tier. So that's kind of the takeaway there. Service credit. How do you earn service credit? How do you maximize service credit? Okay, let's jump right into that question. Those questions. So I'm showing you the pension milestone chart again. You start earning service credit when you enter ACERA. You're going to earn service credit throughout your career all the way up until you leave your job. Service credit is measured in years. When you log into your account on our website, you'll note that you'll see your service credit. Like, so let's say you've been here for 6+ years. Your service credit number would say something like 6.57282 or something like that. All those decimal places are as calculating your service credit down to the fraction of a day. Every 15 minutes you work, you earn 15 minutes of service credit. And you're going to get all those decimal places in the formula for you. So you're earning service credit during all of your regular working hours throughout your entire career. And you're also earning service credit during your earned leave times, including earned vacation leave, sick leave, if you have management leave, if you earn comp time, holidays, floating holidays. When you mark all of these things on your timesheet, all these times of leave, you earn service credit during that time. It's beautiful. They do not count against you for the purposes of earning service credit toward retirement. Now, there are some times when you do not earn service credit, and that is if you are ever out on leave without pay. So you're out of the office, you're on leave, and it's leave without pay. You're not earning service credit during that time. Okay, second bullet point. When you purchase vacation, so some of our employers will allow you to purchase extra vacation on top of your earned vacation. When you mark the purchased vacation on your timesheet, you're not earning service credit during that time. So if you purchase an extra week of vacation, go out on that vacation, mark that on your timesheet, you're not earning service credit during that time. I like to tell people that if you have to purchase a extra week of vacation here and there throughout a long career, I don't think whenever I've done the math that it has that big of an effect in reducing your final retirement allowance. And it allows you to go out on a vacation, an extra vacation for your mental health throughout, your career. So I wouldn't sweat it. Sold vacation isn't the next type of time when you do not earn service credit. This isn't really time. This is where you take your earned vacation, sell it back to your employer for cash. You don't earn service credit if you do that for that time. Also, you don't earn service credit when you go out or when you earn overtime, on-call time, or standby time. Those don't count toward earning service credit. Okay, so that's how you maximize your service credit number by working longer and earning more and more service credit toward retirement. But you can also maximize it a little bit further if you have one of these types of time on this list that is eligible for you to purchase additional service credit. That will increase your service credit number in the formula, which will make your retirement allowance go up. So if you have one of these types of time now, you could submit a purchase request for us to calculate what it will cost you now, or it's good for you to hear this now, so maybe you incur one of these types of time in the future, and then the time to purchase it would be as soon as you can. And I'll tell you why that is and how to do that in just a few minutes. But let me go through the list and show you what the types of time are that are eligible for service credit purchase. Okay, so the idea behind most of these is that, in fact, probably all of them is that it's a type of time where the law did not allow for you to earn service credit during the time, but it does allow for you to go back and buy it later to increase your amount of service credit. Okay, so this first one, the title is, kind of the name, the handle on this is ineligible non-covered service purchase. And so there's a list here. So this would include any part-time work you did for your employer before your full-time retirement eligible position. And what I'm not talking about, what is not included here is work that you did for a temporary agency, an employment agency, or under contract. Those are not purchasable. This is just plain old part-time work that you did for your ACERA employer before you achieved your full-time retirement eligible position. So once you become an ACERA member, by achieving that full-time retirement eligible position, then you can buy that part-time work. Okay, TAP. TAP is Alameda County's temporary assignment pool. That's what that stands for. That is sort of the county's kind of in-house temporary agency. That would be the only type of temporary agency. It's not really an agency, it's their program. That would be the only type of time like that that would be purchasable. All TAP time is purchasable. Seasonal work intermittent work, service as needed work, project work, per diem work. These are labels given to certain types of work that you may have done for your employer before your Acera membership. All that's purchasable. Okay, the 2 week lag between your hire date and your entry date, if you're in one of the 4 employers that has that, that's purchasable. Unpaid medical leave, up to 1 year per instance. So unpaid medical leave is where you're out on leave and it's medical leave and it's for your own medical condition, not anyone else's. So paternity leave does not count here. And that is because the Board of Supervisors has not adopted the code section yet that would allow that to count, from what I understand. So, unpaid medical leave for your own medical condition, when you're out on medical leave and it's unpaid medical leave, when you return from that medical leave, you can buy that time up to 1 year per instance. So if you go out on a year of unpaid medical leave, come back, get at least one paycheck, then go out on another year of unpaid medical leave, come back, both of those years would be purchasable. And in fact, the first period would be purchasable, when you return. State disability insurance leave, similar to the unpaid medical leave, is purchasable when you return from that leave. Sometimes what will happen, and workers' comp leave is included in this category. Sometimes what will happen is you're out, you're being paid partially by the state disability insurance system and partially by your employer. The part where you're being paid by your employer, you're already earning service credit for that. So just the partial portion of that time would be purchasable when you return from that leave. Military leave during membership. This is when you're actively working, you're an active employee. You go out on military leave during that active membership, and when you return from that leave, you can buy all that time upon your return. Okay. This is not prior military service. Unless you did the military service, I think, before 1973, which my guess is anyone in this webinar that does not fall into that category. Okay, so we have 2 redeposits here. We have a redeposit of prior memberships is the first one. This is where you used to work for one of Acera 6 employers. So you were an Acera member in the past, but you left that job. And when you left that job, you took a refund of your employee contribution account. You took your money with you that you had paid into Acera. And when that happened, basically your Acera membership was canceled. You lost all of your service credit from that original membership. Okay, now you're back working here. If you want to get that original service credit back, you can put the money back in, and that is called a redeposit of a prior membership. Okay, next one, redeposit of community property. So California is what they call a community property state, and what this means is that any retirement that you earn with Acera while you are married or in a state-registered domestic partnership is considered community property when you divorce or dissolve that domestic partnership. And the community property is what gets divided among the ex-spouses or ex-partners. So it all depends on how you negotiate it. In some cases, people are able to negotiate other property away and keep their Acera retirement whole. Often what happens is the ex-spouse will get part of your Acera retirement account. They take part of your service credit and a proportionate amount of your employee contributions into their own account. Now, if that happens and they take a refund of their contribution account that went with them, we will notify you by sending you a letter in the mail and give you the opportunity to redeposit an equivalent amount of money into Acera to get that service credit back that ex-spouse took with them. And that's called a redeposit of community property. And from what I've told, we cannot do it unless that ex-spouse takes a refund. So if they're just out there sitting on their account, then we can't do it. And then finally, other California prior public service. Okay, so this one's a little bit different than the rest. These count toward vesting. This one does not count toward vesting. This is where you used to work for another public agency in California and you're not eligible for whatever pension they use from whatever pension system they use. And it's usually because you didn't work there for long enough to qualify for a pension under that system. So for example, let's say you work for the Port of Oakland for a year in the past. You worked there. And a year over there in their pension system, whatever it is, doesn't get you anything. Okay, so we give you the opportunity to buy that amount of time as a Sarah service credit. So you could buy a year's worth of a Sarah service credit. All you would need to do is take a refund from that other pension system. So you would take a refund from that pension system, and then once you do that, we'll allow you to buy that year, and you could even use the money that you got on the refund to make the service credit purchase. Now, one thing that I like to point out here, because people ask about this, they'll say, okay, I have, 5 previous years or 10 previous years with like CalPERS, which is the state's pension system for state employees. And there's other agencies that will use CalPERS to provide retirement to their employees. So like they'll say like I have 7 or 10 years or something over there. Well, my guess, I don't know what their rules are, but my guess is that amount of service credit over in a different pension system actually will allow you to retire from that pension system at some point in the future. You got to check what their rules are, but I think in most cases, and you can run the numbers yourself by getting retirement projections from their website, that it's probably more financially advantageous to you to leave your money over there and actually retire from that other system if you're eligible. So mostly this is for if you're not eligible to retire from the other system. Okay, let me see. I have some questions that popped up here. So somebody says, I worked for 8 years in San Francisco courts. Is that eligible? Okay, that's a perfect example because likely, I don't know what the rules are, but 8 years over in a different system, that will likely get you a pension from their system. And you probably want to leave that there. So check, you would want to go check with that pension system and see what the eligibility requirements are and what 8 years would get you over there before you would make that decision. But the answer is yes, you could buy that 8 years worth. It would be rather expensive. Um, because when you buy these, you're paying the employee contribution part. With this one, you pay the employee and the employer contribution part. So this one can cost triple of what these will cost. And I'll talk about costs in just a minute. Next question. What about time worked as a provisional employee? Well, I think you may want to verify this with my colleagues, and I'll type in our email contact form, acera.org / contact. I think probably you already earned service credit for being a provisional employee because that you were hired into a full-time retirement eligible position. It's just provisional, which is a designation, it's like a certain designation of, whether they want to keep you on or not after the provisional period. But I do believe you earned service credit during that time already. So you wouldn't have to buy it. You already earned it. One way to verify that, another way to verify that is to log into your account on our website, see how much service credit you got in there. Okay, so somebody's asking not paternity leave, but yes, maternity leave, FMLA. So yeah, unpaid medical leave, any maternity leave that's unpaid medical leave, that would count, and you can buy that when you return. FMLA stands for Family Medical Leave Act. That's a federal law that puts kind of like a label on the leave that you are out on and prevents your employer from firing you. And you get to be out on FMLA, I think, for 12 weeks. It guarantees that. Okay, somebody says, what about educational leave? Will you be able to buy that time back? So you go out on leave, probably, I'm assuming, to go for like higher educational purposes. I don't think so. If you're out on that leave and you're using your leave times, um, like your vacation leave and stuff, that would be, you would earn service credit for that. But I've never heard that educational leave is purchasable. But again, you may want to write into us at acera.org / contact to ask my colleagues that question. Let's see, prenuptial agreement preventing this from happening. Okay, so I think you're probably talking about the community property division. I'm not a lawyer or a legal expert of any sort. My wild guess would be that a prenuptial agreement would probably prevent that division of your Acera retirement, but that would be something that you would want to take up with a lawyer. Let's see here. Oh, you're saying you took your money with you. I think you were the person that had that 8 years from San Francisco courts. In that case,
you're not going to be eligible for their pension likely unless they have some rule that you can redeposit money over there. So you may want to check on that. But in that case, you probably could buy that 8 years worth. And for all of the types of time, except for the redeposits, you can just buy a portion of the time. So if we tell you what it's going to cost and you can't afford 8 years worth, but you could afford half of it, you could just buy it, some of it. The redeposits are all or none. And I'll talk about costs in just a second. And then you answered yes as a follow-up. Let me see what the original question was. Yeah, got it. So yeah, I would definitely check with an attorney on that. Okay, let's see here. I have accrued time prior for the working for the state via the CalPERS system. Do I inform them at the same time once I plan to retire from Alameda County? Do the retirement system dates have to sync up with both retirement systems? I think you're talking about reciprocity. In the case that you do have reciprocity, which I will talk about in the second half of the presentation, yeah, you do have to retire from all the systems on the same day. So you would fill out a retirement application under all those systems, and you would put the same day on each application. Okay, so times that are not eligible for purchase that people ask about. I think I already mentioned all of these. Vacation purchase time, you don't earn service credit for it. It's not purchasable later when you purchase that extra vacation on top of your earned vacation. Oh, yeah, absolutely. You're welcome. Non-medical leave without pay. If it's, you'll see that leave without pay, the only leave without pay on here is unpaid medical leave. So all other types of leave without pay are not purchasable. I already mentioned contract or temporary agency time is not purchasable. And the other prior public service, this one right here, where you still have contributions on deposit with that other system, you can't buy it until you take a refund from the other system. Okay, how much does it cost to purchase service credit? Well, it's going to cost whatever your employee contributions had been had you worked the time. So let's say you're trying to buy 3 months of unpaid medical leave time. Had you been here working for that 3 months and receiving your paycheck, we would have taken a contribution out of your paycheck and it would have gone into a Sarah's fund. But that didn't happen because you were out on unpaid medical leave. You were not getting paid. So therefore, you did not contribute to a Sarah during that time. So your purchase cost is going to be whatever those employee contributions would have been had you been here working that 3 months and contributing to a Sarah, plus interest, because had you contributed during that time, we would have invested that money and it would have earned interest. So any interest that money would have earned between the time that you're trying to buy and now is also going to be included in the cost of purchasing the service credit. What that means is that, let me give you an example. Let's say that you were out on 3 months of unpaid medical leave 3 years ago. Well, we have two interest periods per year that ends in July 30th and December 31st. So every time you pass one of those dates, July 30th, December 31st, that's another set of 6 months worth of interest that you're going to have to pay that will add on to your purchase cost. So if it was 3 years ago, that's six-month periods from that 3 years. So that's six individual points of interest that you would have had to, that you will have to pay. We'll calculate it for you. So you don't have to calculate it. But the bottom line there is that the longer you wait to purchase service credit, the more expensive it gets because that money would have been here earning interest had we had it to invest. Okay. So that also means that the time to purchase service credit is as soon as possible. Okay. If you go out on one of these types of leave or one of these things happens and you have eligible time to purchase it as soon as you can. Okay. And the way to do it is that you submit a purchase redeposit request to us. Okay. I need to change this slide. We don't have the purchase redeposit request in the new member portal that we just launched. So what you're going to do, I'll show it to you. Go out to acera.org/forms. You can type it in, or you can just go to acera.org, go under forms and publications, click forms. Scroll down here to purchase request form. Click the DocuSign button. I mean, you can do the PDF, but it's a hassle. When you can do the whole thing in DocuSign, it's all electronic. You don't have to print anything out. So you just type in your info here, and then it'll take you to the form. You have to verify your email address, which is why I'm not going to show you the full DocuSign form, but this is what the form will look like once you get into DocuSign. And you just fill out the info and hit the submit button. And what we will do once we receive that is we'll do the calculations and we'll send you a letter in the mail telling you how much it's going to cost. And at that point, you can decide if you want to make the purchase and how much of it you want to make. Okay. And we'll give you all the options in the letter. Now, there's a little bit of a wait for these. So, if you have the time, go ahead and submit the request. It could take, a few months to get back, to get the letter back because we get a lot of these requests. And we'll give you the payment options in the letter, but just to show you what they will be is that you could write us a lump sum check on a post-tax basis to purchase the service credit. You could roll over pre-tax money from another retirement account if you have one. We'll split it up for you through payroll deductions. So if you're trying to buy 3 months worth of unpaid medical leave, we'll split it up for you over a maximum of 3 months, and we'll take it right out of your paycheck on a post-tax basis to make it convenient for you, or we'll do any combination of the above. Okay, so let's see here. So let me save the rest of the questions that are up on the board for a little bit later, just to keep things moving. And I'm going to talk about those in a little bit. So we talked about the age factor percentage. We talked about the service credit. The service credit was by far the longest discussion here. So that just to summarize, to maximize service credit, you work longer or you make service credit purchases when you can. Okay. Now let's talk about the highest average monthly salary component. How do you maximize that? Well, the bottom line there is going to be you're going to earn higher and higher salaries throughout your career through a combination of cost of living adjustments that you receive throughout the years, every year, raises that you may or likely will receive, or if you go to, you get promoted, you get higher and higher positions. That's probably the quickest way, or the most, quickest is the wrong word, but the most accelerated way to get a higher salary, to increase this, to maximize this number in the formula for you. Okay. So how do we calculate highest average salary? Well, what our software is going to do when you go to retire, it's going to find your period of highest pay from your career, which is known as your final compensation period. That's our pension lingo for your period of consecutive highest pay. And for tiers 1 and 3, it's your highest consecutive 26 biweekly pay periods or 12 monthly, depending on how you're paid. Tiers 2 and 4, it's your highest consecutive 78 biweekly or 36 monthly pay periods. So essentially, for tiers 1 and 3, it's your highest year of pay. And for tiers 2 and 4, it's your highest 3 years of pay, consecutive pay. And since our goal for the calculation is to get an average to find out what you made on average during that highest year, highest 3 years, our software just divides your total pay during that time by the number of months in that period to get an average by 12 months or by 36 months. And that gives us your highest average monthly salary. We plug that into the formula, multiply it by the other two factors, and that tells us what your retirement allowance is going to be for the rest of your life. Now, what types of pay are included? All these types, I'm going to show you 4 bullet points. It's all gross pay before any deductions are taken out, okay? The first one is obvious. Your base pay is going to be included in the highest average salary calculation. It's going to count toward your salary calculation for calculating your retirement. There could be some other types of pay, though. So this would be one way that you could maximize this salary number is if you receive other pay codes, sometimes known as footnotes. They're usually based on skills that you have or education levels that you achieve, sometimes languages that you speak. Some of them count, some of them don't. If you want to see which ones count and which ones don't, go to acera.org/paycodes, open the PDF for your employer, and it will find your pay code that you're curious about, and it'll say yes or no whether it counts toward this calculation, because some count, some don't. And it's all based on, what the law tells us to do. Overtime never counts. That's the one I do know that never counts. Okay, the next 2 bullet points I'm not going to spend a lot of time on, and it's only for tier 1 and 2 people because tier 3 and 4 people can't do it, is vacation sales and vacation cash out. If you are compensated for your earned vacation that you didn't use during that final compensation period, that could increase your salary for the purposes of calculating your retirement. And selling vacation is where you sell your vacation back to your employer while you're still employed. Vacation cash out is where you simply have vacation left over on the books when you stop working, and they'll cash you out for it at that time. And if your final compensation period is at the end of your career, like most people, that vacation cash out, some of that could count. Now, I'm not going to take a deep dive into that discussion here because you don't really need to know that stuff yet. That's a pre-retirement thing. So if you're curious about that topic, I recommend going to acera.org, go to webinars and scroll down to webinars and seminars, click on the pre-retirement webinar, and then all you do is open the YouTube video and scroll forward until you hit this slide, the same slide, and then I do take a deep dive into that topic if you're curious. Like I said, you don't need to know that right now. You don't need to really dive into that info. One thing I will answer a question up there. Is there a maximum number of vacation days that can be cashed out? Yes. It's 2 times your annual accrual rate. So let's say that you earn 2 weeks of vacation per year and you have 4 weeks on the books when you stop working for your job. Well, that's fine. They will cash you out for all of those 4 weeks of earned vacation that you have not taken. If you have 5 weeks on the books, however, the extra week above 2 times your annual accrual rate of vacation will go poof. It will vanish into the ether and you will not get anything for it. You won't get cash. You won't get to take that vacation. So be cognizant of that when you leave your job, is that you don't want to have more than 2 times your accrual rate of vacation on the books. Okay. One thing that I want to point out here. Oh, and somebody's asking, is there a maximum sick leave credits you can cash out? Well, for sick leave, you don't get cash. You get service. You get additional service credit for it if you go straight from active work into retirement. Well, the amount that's of sick leave that we can convert into service credit, it's usually on a 2-to-1 basis, is in your memorandum of understanding. That's your basically your contract info for your bargaining unit. And so you would want to ask. You can find that on the county's intranet, or you ask your HR department to read your MOU, memorandum of understanding. Okay. Let's see here. Let me tell you about this one limitation on your benefit payments that I like to point out here. There's a few more limits that you can read about. Most people don't hit them, but they're at acera.org/limits. This is kind of the pertinent one for this webinar, is that tier 4 people, there's an additional part of the law that created tier 4 that tells us, Acera, when we go to calculate your retirement, we cannot use any more annual salary dollars to calculate your highest average salary than this cap that is based on the Social Security wage index limit. We publish this out on our website. It goes up every year. So when you all finally retire, it will likely be a lot higher than this. But what this says is that general members, we can't use any more annual salary dollars than $155,081 for 2025. And for safety members, it's $186,096. We can't use any more than that to calculate your retirement. Now, that's kind of the downside. The upside is that the way it functionally works is when you hit this cap during the year, let's say you have a higher salary than these salaries, and you hit this amount, you've earned this amount, you've been paid this amount by your employer, let's say in October. Well, for the remainder of the year, November and December, we stop taking employee contributions out of your paycheck from Acera. And that gives you more money to save in your personal savings or your 457B account. And then your employee contributions will kick back in on January 1st. More info at acera.org/limits. Okay, so here is the entire thing put together, the entire pension formula. This is just an example. You have a tier 4 member here. They retired age 65. So based on tier 4 age 65, their age factor percentage is going to be 2.30% from the age factor percentage chart. This person has earned exactly 25 years of service credit down to the zero decimal place, but you can see us putting all the decimal places in the calculation for you. So the age factor percentage times their years of service credit times their $6,000 highest average monthly salary in this example would equal, when we multiply it all together, a $3,000, 400, $3,450 dollar monthly retirement allowance for the rest of their life, every month, plus cost of living increases. And one more thing that I want to just point out and remind you of is if you take the age factor percentage and multiply it by the years of service to see what percent, so you're getting 2.30% for each one of these 25 years, multiply them together, that tells you how much salary replacement you're achieving. 57.5% salary replacement. This person is replacing 57.5% of their $6,000 salary with their monthly retirement allowance of $3,450. And the reason I point out this number is because I mentioned the goal is to get above 80%. If you achieved this level of salary replacement from the Acera pension alone, you'd be doing really good because you're going to be able to put Social Security in there and then any additional savings, which we'll talk about when we get to that point. Okay, let me show you how to get a precision pension estimate. And then we'll take a little break, a little 5-minute break. Okay, so you go to our website, click the login sign up button. It's acera.org. Click login sign up. Okay, I already showed you how to get in there and request a PIN to create an account if you haven't already done it. So I won't go over that again. But once you get in there, once you sign into your personal account, which has your personal pension data in it, that comes from our pension software, you click estimate a benefit and you'll see this screen. Estimate a benefit. This is our benefit estimating tool for you to get a precision pension estimate. So you're getting a peek into the future. So I'll just zoom in here so you can see it a little bit better. All you do is you think of a plausible retirement scenario for yourself that you want to get an estimate of. In this case, this person says, what happens if I retire in August of 2040? You're going to plug in 2 dates. Separation date is your last day on payroll with your employer. Payments begin date, that's your first day of Acera retirement. So if you want to do a scenario where you're going straight from active work into retirement, these should be just 2 consecutive dates. Payments begin date should be the next day after the separation date. But if your scenario might be different or you want to see what happens, for something different, like you stop working and defer your retirement to a later date, you can do that. Just put in the dates that match that scenario. You can put in beneficiary info if you want. I recommend not overriding the service credit or salary amount, but you could if you wanted to. But if you don't, you'll get a nice conservative estimate, and then you hit generate, and you end up with this. It's a PDF, retirement benefit estimate. So you save this on your device. You can make as many of these as you want. Like you can use this system as much as you want, make 52 different estimates for every week next year, see what happens. Make an estimate for 2040, 2041, 2042. Just try it out and see what the result is. So this is a PDF. You can print it out. You can save it on your device. The second page shows you some of the info that it used to make the calculation. And yeah, I have a zoom in here of page 1, which is your estimated monthly benefit. So this is a table on page 1. And when you go to retire, on your retirement application, there are 5 different benefit options, unmodified options 1 through 4. You don't really have to understand those right now as a new employee or mid-career employee. I just recommend keeping your eye on the unmodified option. It pays the most to you. This is the one that the vast majority of people select because it pays the most. And so you can just kind of use this number for your own personal retirement planning as the unmodified option. If you're curious about what these different options do, there's more info on our website. Okay, so let me help you understand your retirement eligibility. We're talking about this spot on the pension milestone chart. This is when you become first eligible to retire, and you can retire on this day if you want, or you can keep earning and working and earning more and more credit toward retirement and retire at a later date. You have three different combinations that get you to retirement eligibility for tiers 1, 2, and 3. I'll show you tier 4 in just a second. Your first combination is that you are at least age 50, you have at least 5 years of service credit, and you have at least 10 years of membership. Now, tiers 1, 2, and 3 closed over 10 years ago, so everyone already has 10 years of membership in those tiers. So now you're just looking at 5 years of service credit and being over age 50, and you can retire. Okay. Option two is that you can have 30 years of service credit as a general member or 20 years of service credit as a safety member and retire at any age, even if it's younger than age 50. Or option three is that you can have any amount of service credit and retire at age 70, even if it's less than the 5 years you need under option number one. So those are the three combinations that get you to retirement eligibility in tiers 1, 2, and 3. Tier 4, you have two combinations. Option number one is that you are at least 52 years of age as a general member or 50 years of age as a safety member, and you have at least 5 years of service credit, then you can retire. Option number two is you're at least age 70 and you can retire with any amount of service credit, even if it's less than the 5 years you need under option number one. And that's how you achieve retirement eligibility. So that topic, pretty simple. Okay, let me see. There's a couple of questions on the board. Somebody asked, can I use the 8 years with San Francisco retirements as service credit for Acera? I am 99.9% sure you can. So yeah, submit a service purchase request. Go to acera.org/forms. It's called purchase request form. And submit that to us. We'll calculate the cost and send you a letter in the mail. Next question. Does the retirement calculator take into account possible raises in the future, or does it only use current salary? Oh, I think I answered that question during the break. So yeah, it only uses current salary. So just for the purposes of the video, if you want to see the effect of greater salary in the future, then you're going to want to override the salary by checking the box and putting a higher salary in here, and it will use that to calculate. And when you look at page 2 of the estimate, it will show you what the amount of the salary is that it's using for that PDF estimate so you can keep track. Okay, let me help you understand some additional benefits that we offer. I'm going to talk about briefly, very briefly, medical, dental, vision, and other non-guaranteed benefits, disability retirement, and I will talk a bit about death benefits should you die before you retire. Now, regarding, I don't have a lot of info on the disability retirement, but I just want to mention that this concept exists at this point. If you become permanently disabled during your career and you can no longer perform your job duties, then you can apply for disability retirement. So it's kind of a separate retirement than the regular retirement that we call service retirement. So you would want to go ahead, your destination for that info would be acera.org. You go under members and you click on disability retirement, or just go to acera.org/disability, and that's the shortcut that gets you there. And we have a whole page on that. Okay, so now let me tell you about the non-guaranteed benefits first. I've been talking a lot about guaranteed benefits, the retirement allowance, and the rest. Now let's talk about non-guaranteed benefits, also known as non-vested benefits. These are extra benefits that Alameda County in the 1980s decided they wanted their retirees to have to pay for some extra things, extra costs in retirement. And so they started a reserve fund that Acera administers. So Acera's Board of Retirement administers this reserve fund called the Supplemental Retiree Benefits Reserve. And it pays for subsidies for retirees for medical, dental, vision, Medicare, and supplemental cost of living adjustment. This is the current set of benefits that the Board of Retirement offers. And they set the rules on this fund, which is what you're seeing here. This is the rules regarding who qualifies for the benefits, which retirees, and it's based on years of Acera service credit to qualify. The reason that they have the rules is because they want to maintain the sustainability of that reserve fund so they can continue offering medical, dental, vision, Medicare, supplemental COLA benefits into the future. So they keep a very close track on this fund. Currently, it's very sustainable. There's over $1 billion in there. The sustainability amount is years and years into the future. So if you want more information, you go to sarah.org/SRBR. But that's kind of a digression. The main thing that I want to tell you about now, because some of this stuff might look different when you all go to retire, okay? The medical plans, the dental plans, whatever, might look different, okay? The main thing that I want to stress, because this is a new employee mid-career webinar, is the years of a service credit to qualify for these, because this will help you in your career planning to know how many years of a service credit you need to start being able to access these subsidies in retirement. And so you see that all of them start at 10 years, except for the supplemental cost of living adjustment. That one's different. But you at 10 years, you would achieve the dental and vision subsidy and the Medicare subsidy and the first level of the medical subsidy, which is called the monthly medical allowance. And then if you hit 15 or 20 years, then you would get more of a medical subsidy, okay? And so what I like to do is go back to the pension milestone chart and actually add a milestone in here for healthcare subsidies for the purposes of retirement planning. So let's say that you have already worked for 9.5 years and you're considering finding another job somewhere else. You already have 9.5 years of service credit with Acera. Now that you've seen this, that might make you think maybe I should stick around for another 6 months, get over that 10-year mark so that I can access these benefits: dental, vision, Medicare, and the first level of the monthly medical allowance. That's going to represent a lot of extra money in retirement that you get in addition to your retirement allowance. Okay. So I just like to point this out for you all so that you can be cognizant of these amounts of a service credit. Basically, these service credit milestones, 10 years or 15 years or 20 years, that will get you those additional subsidies. So that's basically what I want to tell you about the healthcare stuff now. If you want more info, we have a whole page on our website about what the current healthcare benefits are. Now, let me talk about death benefits. And as part of that discussion, designating your beneficiary or beneficiaries for those death benefits and keeping them current. Okay. Let me define a term. What is a beneficiary? A beneficiary is just somebody who gets benefits. Now, your Acera beneficiary, in the context of Acera, is the person that you designate with Acera on our beneficiary designation form to get your Acera death benefits after your death. Okay. So what are the death benefits, first of all? Okay, in all cases here for this webinar, we're talking about should you die before retirement and what the death benefits are. Now, after retirement, there's a different set of death benefits, which we talk about in the pre-retirement webinar. If you're curious about that, you can go watch that video. This is death benefits should you die before retirement. So this kind of helps you with your life planning and making sure that your beneficiaries are taken care of in the event that you die before retirement. First off, if you are a non-vested member, so you're actively working for one of Acera's 6 employers, but you're not yet vested with that 5 years of service credit. And just as an aside, reciprocity counts toward vesting. So if you are a reciprocal member that has 5 years combined among all the linked systems, you are considered vested. Okay. So this is just non-vested members. What your beneficiaries would receive should you die before retirement would be basically a refund of your contribution account. So all the employee contributions that you paid into Acera plus all the interest that we posted already, they would get all that back. We would give that to them. Plus, they would get 1 month of your current salary at the time of death for each year of service that you've already worked, up to 6 months worth. So let's say that you've already worked for 4 years and you die as an active member. They would also get 4 months of your salary in addition to a return of the contributions and interest. Moving on to vested members. If you already have 5 years of service credit with Acera, your beneficiaries have an expanded set of options. They have 3 different options that they would get. And you don't really choose the option for them. We give them the options after your death. But option number 1 is the same as the non-vested. It's the same thing, return of the contributions and the salary, and the 1 month of salary for each year of service. Okay, now option number 2 is a monthly survivor's allowance to a qualified beneficiary only. And qualified beneficiaries are spouse and domestic partner and minor children. Spouse and domestic partner, we get a lifetime survivor's allowance. Um, Minor children would get a temporary allowance until they reach age 18. Okay, but don't worry about that. You don't need to fret about that because I'm about to show you how to get around that. And I don't really mean get around that, but what I mean is how to make it so that it extends for their lifetime. Option number three is 1 month of salary for each year of service plus a reduced monthly survivor's allowance. Okay. What I recommend is don't look at this slide, look at the next slide. Vested members with the advanced death benefit election. Okay. So option number one is the same. Option two is a maximum monthly survivor's allowance. What this does is it does two things. It increases the monthly survivor's allowance to whatever the maximum that they could get is. And the second thing it does is it allows you to name anyone for a lifetime continuance. So, minor children, if you don't do the advanced death benefit election, they would only get a temporary continuance. By doing the advanced death benefit election, you ensure that they get a lifetime continuance and it's maximum. Or you can name somebody who's not a spouse, domestic partner, or minor child. It could be a friend, cousin, anyone. Um, it's any human, and you can name multiple people for a lifetime continuance. Okay, which you can't do here. Okay, without the advanced death benefit election. So this does a few different things. The way to make the advanced death benefit election, and every active member should do this, even if you're not yet vested or you're going to become vested much later. You just go ahead and get this in. And when you become vested, it kicks in automatically. Okay. So everyone on this webinar, everyone watching this webinar video later should do this. There's no downside. If you want more information about it, acera.org/ADV is the website. But really, all you need to do is go to acera.org/BEN. That is a shortcut to a PDF form. Okay, so you type that in, the form pops up, save the form to your device. You can fill it out electronically except for the signature. Then you print it out, sign it. There's 5 different methods that you can send it to us. And those instructions are at the end of the form. Okay. And all you need to do, you make sure that there's one box to check. It's very simple. You check the box, Advanced Death Benefit Election. Okay. And then you print it out, sign the form, follow the instructions to submit it to us. Everyone should do this. You should do it today if you haven't already done it. If you're not sure whether you've done it, just fill it out again. Send it to us. Every time you submit a beneficiary designation form, it supersedes whatever the previous designation forms were that you submitted to us. And so that's the way to make sure that that is in place. And before I talk about that, one more thing I want to talk about is keeping your beneficiary designations current, okay? So you can change your beneficiaries at any time as an active member. It's just every time you do it, make sure you check that box, Advanced Death Benefit Election. It's very obvious. There's a big arrow to it. There's bold letters, Advanced Death Benefit Election. But you can check your beneficiaries in Member Direct by clicking on Beneficiaries. And if you go here, and you see that your beneficiaries are outdated, like you see your spouse from 3 spouses ago, go ahead and redesignate your beneficiary today. Okay. So acera.org/BEN is the shortcut. Now, I skipped over one item, which was what happens if you are a deferred member and you die. Deferred members are when you stop working, but you defer your retirement to a later date. So you're kind of a member, sort of in limbo a little bit. Your your membership is just kind of in stasis. And what your beneficiaries would get if you die as a deferred member is a return of the contributions and interest. Okay, so this is perfect. We have about 40 minutes before our 457B expert joins us, so we have exactly enough time to complete the rest of the info. I see a question just popped up on the board. Um, oh yeah, so you're asking, what if you're a general member who has 20 years of service transfers to safety? Do those years turn into safety since you are now safety? Well, for the purposes of calculating your retirement, they don't turn into safety. But for the purposes of retirement eligibility, I am 99% sure that would make it so that you could retire with the 20 years of service um, under age 50. And I think that is a life hack. Verify that right into acera.org/contact. Verify that with my colleagues, just to make sure I'm telling you the right thing. But yeah, you could go through. I mean, if you want to become a law enforcement officer, you could, sign up for you know, the the sheriff's academy and go through that, and I think that would do it. Okay, let me help you understand some career planning options. What I mean by career planning options, just to remind you, is that at some point in your position, you're going to stop working in that position, whether you go straight into retirement or whether you stop working before you retire and do something else. Okay. So, in any case, in any scenario, what will be your options in terms of the retirement that credit that you have earned with Acera and your membership with Acera and your future pension with Acera? What are your options? Okay. I'm going to show you two overarching options. First one is working straight into retirement, which is what many people do. You work your career past your retirement eligibility date, and then you retire immediately upon um, leaving your job the next day. That's working straight into retirement. And if you do that, you're going to earn service credit right up basically to your retirement date. We'll convert your sick leave on a 2-to-1 basis to service credit. Um, I actually learned that recently there's an MOU where we do 2/3 of the sick leave converts to service credit. It's all based on your MOU. You could go work somewhere else if you want. And we will consider you an Acera retiree, and we're just going to pay you every month for the rest of your life. And you can go do whatever else you want, work wherever else you want, and get your retirement at the same time. Okay, so that's basically option number one is when you stop working in your job, you just retire if you're eligible. Um, Now, maybe you're not eligible to retire yet the time you stop working your job, or maybe there's some other reason that you don't want to retire immediately. So if you don't retire immediately when you stop working your job, you kind of have three sub options. I'm going to label them A, B, and C. Okay. So if you terminate before retirement, option A, and actually I'm going to change the milestone chart around here so that there's a space between terminating employment and your retirement date. So you're not retiring immediately. Option A is become a deferred member. Okay. So we kind of have in one sense, we have three types of members. We have active members who are actively working, paying into the system, earning credit toward retirement. We have retired members who have retired, and then there's the in-between category where you stop working and you don't retire yet. You defer your retirement to a later date. That's what we call becoming a deferred member. Now, the word member is still in the term, deferred member. You're still an Acera member as a deferred member. You're just kind of in a holding pattern. You're in stasis because you're not paying into the system anymore. You're not making employee contributions, and you're not earning service credit. As a deferred member, because you're still a member, that means that you have left your retirement contributions on deposit with Acera. You basically become a deferred member by not taking a refund of your contribution account when you leave your work. As such, because we're continuing to invest your money, interest continues to accumulate. And there's no negative interest. And people will ask me, what is negative interest? Well, I made up that term because I wanted to communicate that there's no risk to leaving your money there because your balance of your account never declines. If in a particular investment period, Acera's investments temporarily lose, like, are have a negative return, we don't take any money out of your account. Your account only goes up. So every time we earn interest, we post it to your account and your account only goes up. And if you look at the amount of interest that we have historically earned, and of course, the past does not necessarily have any connection to what's going to happen in the future. But if you go to acera.org/interest, which is the shortcut, you can see how much interest that we have historically earned all the way back to 1993. And we've annualized it here about 7.67% per year. I don't know anywhere else you can park your money with zero risk that has historically earned that kind of interest. And like I said, that doesn't mean we're going to earn that interest in the future. The future is unknown, but um, in any case, if we earn interest, your account goes up, never goes down. So it's a completely safe place to park your money. You can retire later out of deferred status. So you can stop working, decide that you're not going to retire immediately, retire at a later date, and then out of deferred status later, you can decide I'm going to retire later. Or somebody was making an example earlier that they may leave work before they're eligible to retire. Well, that would be a good example of a reason that you would not retire immediately. Like if you stop working when you're 40 with a good amount of service credit and you got to wait 10 years until you're 50, then you can, leave your money parked there, retire in 10 years, and at age 50, and we will pay you your lifetime retirement allowance starting at age 50. And so that's a good reason to become a deferred member. You can come back to work and earn more credit toward retirement later if you become a deferred member. So that would be a reason that you might become a deferred member is if you're not sure whether you're going to want to come back to work for one of our 6 participating employers in the future or not. That would be a reason to become a deferred member. You could also be refunded at any time. So you're going to see that option C, this is option A, option C is going to be to take a refund of your contributions. So let's say that you stop working and you don't know what you want to do yet. You haven't decided. Well, you don't need to take a refund right at that time. You can save that decision for later and you could be refunded later. And if it's years later, you would have earned a lot more interest on that money. There's more info at acera.org/defer. There's a list of good reasons to become a deferred member. There's a list of not good reasons to become a deferred member. I can tell you off the top of my head, a not good reason to become a deferred member is if you stop working, you know you're not going to come back to work here. You're already eligible to retire, but you're just waiting for your age to get bigger, so you get a bigger retirement allowance. If you do that, yes, you'll be older when you retire. You'll get a higher retirement allowance, but in the meantime, you're missing out on monthly retirement payments. And whenever I've sat down to do the math, you never catch up. You never fully make that money back that you missed. Somebody's asking if you return as a retired annuitant, do you earn retirement on the salary? Okay, so this is a good question because something just happened 2 weeks ago that expands your options here. And I haven't even had a chance to add it to the slide. We haven't added it to the website yet, info about this. Okay. Previously, the rule was that you retire from Acera and you basically can't unretire. So if you want to go back to work for one of Acera's 6 participating employers, there's rules about it. You can't really work more than half time, like half hours for the entire year. And there's like a waiting period, a 6-month waiting period. Okay. This board of supervisors 2 weeks ago, I think 2 weeks ago now, passed a new code section that does allow people to go back to work for one of Acera's 6 participating employers. And let me just take an aside here. Let me step back. That first thing that I was telling you about, that's called becoming a retired annuitant, where you retire from Acera, you draw your lifetime pension, you come back to work, and you're not earning more credit toward retirement. You're just getting a paycheck from your employer, and there's rules and restrictions around that. Now, what the board passed 2 weeks ago, the Board of Supervisors, is a new option. If you're eligible to retire, when you leave work, you can go ahead and retire. And you could come back to work for one of our 6 participating employers later, full time, and you could earn more credit toward retirement. And basically, you would be earning kind of a second retirement. So what we'll do is we'll put your first retirement on hold. So you would not be collecting your pension when you go back to work, but then you would earn kind of a second retirement in a second career. So you'd earn more service credit. Your tier would be the original tier that you're in, I think. I don't know what the rules are. It's brand new. But then you can retire from the second one. We'll calculate the second one. We'll restart the first one, and we'll send you one check. Basically, is the bottom line there. So that's an additional option that you now have. Okay, so option B. That's option A, becoming a deferred member. Option B, establishing reciprocity with a different retirement system in California. Reciprocity simply means the reason we use that word, we have a reciprocal agreement with other systems that will all kind of do the same thing. Other public California retirement systems, we all work together reciprocally. And establishing reciprocity is linking multiple retirement systems together. We have reciprocity with many cities in California, all the counties in California, California state jobs that use CalPERS. CalPERS is the state's pension system, not the UC system. We don't have reciprocity with them. Or any agency in California. There's many agencies that use CalPERS to provide retirement to their members. We have a full list at acera.org/reciprocity. And the reason that you would link systems together when you go from one system to the next is there's some synergy that you get between the systems. There's benefits to establishing reciprocity by synergizing these systems together. The first benefit is that the service credit you earn in all the systems combined is used for vesting and retirement eligibility requirements. So, for example, you work for 3 years over in Contra Costa County. You come over to Acera and work for 2 years. And when you come over to Acera, you establish reciprocity and link the systems together. And let's say that you're a tier 4 member over age 52. Okay. Between the 3 years over in the other county and the 2 years here, that's 5 years combined. You are vested in both systems and you're eligible to retire in both systems, even though you only have 2 years with Acera. So that's the first benefit of reciprocity is the synergy of the service credit combined across all the systems. The second benefit is that all the systems that you have linked together will use your highest salary that you earn under any reciprocal system. So to continue with the example, let's say that you work over in Contra Costa County for 10 years and you were earning $20 an hour over there. You get a job over at Acera and now you're earning $35 an hour here. Okay. And you work for, let's say, 10 years here. Okay. And then you retire from both of those systems on the same day, which I'm going to show you that you have to do. Okay. Both systems are going to do a separate retirement calculation for you. Okay. At Acera, we're going to use your age factor percentage here, your 10 years of service here, and your salary here because it's higher. It's the highest of any of the linked systems. When Contra Costa County does your calculation over there, they're going to use your age factor percentage over there, your 10 years of service credit over there, and we are going to communicate your highest salary to them, and they're going to use that salary in the formula over there. You're going to get way more money from them than you would have had you not established reciprocity because you have a much higher salary. The third and fourth things is that if you establish reciprocity, it's possible that you would pay a lower contribution rate than if you had not established reciprocity based on how the contributions are calculated. So that usually happens, but sometimes it doesn't. Reciprocity, establishing reciprocity could also put you in an earlier tier. So if you have an entry date before the cutoff date for one of Acera's tiers, and that entry date from the earliest system that you have linked together would put you in the earlier tier with Acera, then we will do that for you. How to qualify for reciprocity? All you need to do is 4 things. 1, you leave your contributions on deposit with every system you're trying to link together. You do not take option C, which is taking a refund. No more than 6-month gap You can have no more than a 6 month gap between when you terminate one employer and start the next job. Okay. So you want to start the new job within 6 months of having left the other job. You can have no more than 12 weeks of overlapping service um, when you're coming into a Sarah. So, or I think also when you're leaving. To make it easy, don't have any overlapping service. People will do this where they'll go on vacation leave in one job and start the next job while they're on vacation leave in the first job. Just don't do any of that, and it will make it easy for you. They're gonna cash you out for your vacation anyway, so you're gonna get the cash for it. You also must retire from all the systems on the same day to keep reciprocity whole. Okay, so that's reciprocity. You can link as many systems together as you want, and that would be one way to really dial up that salary component of the retirement formula is to get, look for a different job where you have a higher salary. And if you can't find one in our system, then you could go to a different system and find that higher paying job. And that would increase your salary across all the linked systems together. Option C for when you leave work but don't immediately retire is taking a refund of your contribution account. So we'll give you back all your employee contributions and interest in a one lump sum payment. Now, if you're just looking for cash, you're probably going to lose a third of your money immediately because we're going to withhold taxes that you're going to owe state and federal. Plus, if you're underage, I think 59 and a half, you'd want to verify that on the web. But you will owe tax penalties for early withdrawal from a retirement account, and you'll basically lose a third of your money right off the bat. If you don't want to lose any of your money at that point, you can roll over those funds from a Sarah into a pre-tax retirement account that you have opened or that you already have, and we will help you do that. Refunds take time. It's not an instantaneous thing. You can't quit and get a refund the next day. It takes 45 or 60 or more days. So it's not instantaneous. And when you do it, you're waiving your right to all of Sarah's benefits. You're saying, don't give me my lifetime pension. I don't want access to any of the healthcare benefits. I don't want my beneficiaries to have access to any of the death benefits. I just want to take my cash and go somewhere and, try to do something different with it. And that's totally fine. That's your right. Just one thing that I said I was going to try to talk you out of taking a refund. I mean, it's up to you. You do what's right for you. You sit down, do the math, do what's right for you. But I just want to remind you that if you do retire from a Sarah, even if you stop working and you're not eligible to retire yet, and you got to wait for that age 50 or 52 or whatever it is, depending on your tier, it will likely still be way more financially advantageous to you to retire from a Sarah than take a refund. Because if you remember, I told you at the beginning of the presentation that when you retire from a Sarah, we're already going to refund all your money to you, your employee contributions and interest, but through retirement payments within the first 3 to 5 years of your retirement. So we're going to give you your money back, but on a monthly basis for that first 3 to 5 years. And then you're going to get to collect a lifetime pension beyond that, which you would not get to do if you just took a lump sum payment. And I think my educated guess is that when you sit down to do the math, you will find that it is more financially advantageous by far in most scenarios to retire from a Sarah than take a refund of the contributions and interest. But like I said, don't take my word for it. You can sit down and do the math yourself. Okay, so now here is where we bring it all together. We make a retirement planning picture. We're going to take, now that we understand exactly how a Sarah works, we're going to take a little peek into the future. We are going to see what your possible income might be in retirement. And then we are going to use the intervening time that we physically have between now and then to make sure that your retirement is dialed in and that you have adequate retirement when you get there. Okay, here's how we're going to do that. And you're seeing this slide again for the second time. Okay, this is a picture of the future. This is a picture of your possible retirement income when you go to retire. You're going to get income after retirement from your Sarah monthly pension. Okay. If you, you know, earn the necessary amount of service credit, you become eligible, and then you retire from a Sarah. Any other pensions that you might have from other public agencies, you can kind of put that into this category here. Social Security, you're paying into the Social Security system, most of you, unless you're a safety member, you're not. But if you pay into Social Security for at least 10 years, they say 40 quarters, but that's, 40 quarters is 10 years. You will get to collect Social Security when you become eligible for that. The earliest age is age 62. Okay, so you can add that into here as part of your income that you're going to uh, receive when you retire in retirement in the future. And then anything beyond that is your personal savings and investments. Okay. And like I said before, financial planners will tell you that in order to maintain your standard of living, you're going to need to replace 80% of your working salary with this retirement income from these three categories. Okay. So how do we ensure is the wrong word. How do we get you pointed in the trajectory so that it's it's highly probable that you are going to achieve the income replacement that you're looking for by the time you retire. How do we do that? And I see a raised hand. Go ahead and type your question in the Q&A feature, and so I can get that question answered. Um, so first off, how do we do that? Well, we're just gonna sit down. We're gonna get some estimates, and we're gonna just use some technology to get you pointed in that direction. Okay. The first thing that we're gonna do is get your Sarah retirement estimate. I already showed you how to do that. Okay. And the second thing we're gonna do is get your Social Security estimate. So you could get out when you sit down to do this. You get out some, a piece of scratch paper or notebook, or you don't even have to do that because these are going to be electronic estimates. You could just save them on your device. Okay, so the Acera estimate, just to remind you, is you go to acera.org, click the login button, go to estimate a benefit, plug in your retirement scenario that you want to get an estimate for that is a plausible retirement scenario for you. Maybe you want to see what happens if you retire at age 55 or 60 or 65 or 62, the Social Security one. I'm gonna do 62 for this example because I'm gonna want to plug in the Social Security number, just to give you an example of that. Okay, so you generate your Acera retirement benefit estimate. It's a PDF. You save it to your device, and then you're gonna look at you for the purposes of this future projection, you just look at the unmodified number. Okay, and so you write that on your scratch paper. You just make a note of that number. So like I said, I'm doing an estimate for age 62. Then you're going to get a Social Security estimate. You go out to ssa.gov/estimator. You log into your account over at Social Security. They have an estimator for you, which is personalized to you based on your records at Social Security. They will give you an estimate that will look kind of like this. Okay. They'll show you some different retirement ages where if you start collecting Social Security at that age, then they'll show you how much they'll pay you per month out of the Social Security system. Okay. So you can write that on your scratch paper. Just make a note of what the amount is at the age that you're working on right now, that you're trying to get a projection for. Okay. So like I said, I'm going to do age 62. So we're looking at about a 2,200 Acera estimate and a 1,700 Social Security estimate. Okay, so the question at this point is, you got these two estimates, right? And it's showing you these two dollar amounts. How are you to know whether this is going to be adequate pension income? You could sit down and add it up like I was showing you in that equation, but I don't think that's the best way to do it. There's technology out there. There are retirement calculators that you can use for free out on the web that will get you pointed in this trajectory and that will show you whether they think you're going to have enough income based on the pension and Social Security alone. Okay. Um, when I bring in the 457B expert, who talks about the 457B plan, he's going to talk about the Empower retirement calculator that you get when you log in to your Empower account. This is probably the most powerful calculator that will probably give you the best number. I'm going to show you what it looks like to use one of the free calculators. I'm going to show you the Vanguard calculator, which looks like this. And I'll actually just do a demo of it, just to show you how to do this. Um, on our website, acera.org, go under members, go down to the third option, planning your future retirement income. You can just type in acera.org/planning if you want. And this, later on, when you sit down to do this, this article will also walk you step by step through um, the this process. Okay, hang on one second. Oops, hang on one second. Okay, so there are some links here. There's a link to the Social Security estimator. There's a link under here to log into your account. With Acera, it looks like I need to update these screenshots for the new with the new member portal that we just launched. So sorry about that. And then so you can get your two estimates there. And then if you scroll down here, calculate how much more to save, or if you need how much, if you need to save more, you start here. Okay. So I'm going to show you this Vanguard calculator, but these are links out to these free calculators. That you can use. These people are all trying to sell you their investment products, which is why they're providing a free calculator. And they're going to say, "Oh, you need to save more money. Here's where you can save it," but you don't have to invest with them. And in fact, I think a really powerful place to put your money is going to be in your 457B account, which we're going to do a whole presentation about in about 15 minutes, starting in about 15 minutes. And then you can use the Empower Retirement Calculator inside your Empower account when you start that 457B account. Okay, so just to show you the Vanguard calculator and how this free calculator works, I'm going to do a scenario here. Let's say that this person is 30 years old. Okay, so it's going to ask you for some info about yourself. Let's say I want to try to retire at age 62, and I want to see what happens if I can do it, and what I would need to do to make that happen. Okay, and this is asking for a salary. Let's say it's 80,000 a year. Okay. And then this is asking for how much money of your salary you already saved for retirement. And it's going to give you a percentage. So if you saved 1,000, that's, 1.3%. I'm going to leave it at 0 for right now. Let's say you don't save any money for retirement currently. You don't even know how much to save. So you save nothing. And let's say that you've already saved nothing. You have no retirement savings. Let's just leave that at 0 for now. Okay, so this number is where you would plug in the income replacement percentage that you are wanting to get pointed at in this exercise. I'm going to plug in 80%, but what our expert Gene Hilliard is going to try to get you to do when he starts talking is he's going to try to talk you into trying to get pointed at 100% income replacement, just to give you a buffer. I'll stick with 80 for now, just for this example, in case that's what you want to do. Okay, now the last number that you're going to need to plug in here is a little bit subjective. Okay. It's asking what type of annual return that you might expect on your retirement savings. So if you do save additional money toward retirement, where you save that additional money will dictate over the long term what percentage you're going to earn on that money per year. Okay. When you save it. What I like to do for myself is pick a number between 2% and 7%. Those are actually pretty conservative numbers. 7% is what Acera projects that we will earn on our investments annually. but it all depends on where you plan on putting your money. The more potential for higher percentages is that you can earn is more potential for risk. What what people like to say about that is it, it's risky, but that's really if you think about it in terms of short-term investing. If you put your money somewhere, there are ups and downs in the market over the short term. If you look at a long-term history of markets, though, you'll see that over long periods of time, even though there are ups and downs, it markets tend to go up over time. If you look at the S&P 500 or just the markets in general, they tend to go up over time. So the longer you leave your money in, the more um, it kind of like somewhat reduces risk by leaving it over long periods of time just based on the history of markets. But like I was saying earlier, what happened in the past doesn't necessarily determine what's going to happen in the future, but you don't really have any control over that. So I recommend just putting in a number here between 2% and 7%. I'll just put in 6% just to be kind of extra conservative. Okay. So we're going to park our money somewhere where will expect to earn, at 6% over long periods of time. Okay. Now, in the estimates that we've already gotten, this calculator is allowing you to put in Social Security and pension estimates. And I recommend only using ones that allow you to do that because this gives you the complete picture of your retirement from all three sources of income. Okay. So the estimate was about 1,700. The pension estimate from Acera was about 2,200. You can do it exactly if you want. You can use this, um, do this a bunch of times, try out different scenarios just to get a handle on what this thing is doing. Okay. So what this is showing is in this column, it's showing you, according to the way Vanguard has programmed their calculator, how much retirement income it thinks that you will need in order to maintain your standard of living when you get toward retirement. This column is showing you how much it projects you will have based on all the numbers that you plugged in. Okay. The darker green is Social Security, the lighter green is your pension benefit. And you can see that there's a gap here. And the goal would be to get these equal. Okay. So what we're going to do is we're going to see what happens because this is telling me I will not have enough income if I don't save additional money. There is a gap here. What happens if I save additional money? Okay, so I'm going to edit the results and I'm going to see what happens if I save $1,000 per year, which would be 1.3% of my salary in this example. I'm going to hit recalculate. Okay, so it added a bar here, but it doesn't quite get me up to what I'll need. Okay, so what happens? Let me bump it up to $6,000 per year, which would be 7.5% of my salary. Okay, so it is there's still a bit of a gap. So what happens if I go up to 7,000? You just gotta kind of have to play with this to try to equalize these bars out. Almost there. Okay, so those are about even there. I mean, you could get it exact. So this is saying in this scenario where a person is 30 years old, they're going to retire at age 62, they make this salary, and they're saving 10% of their income for retirement annually, they will achieve 80% income replacement if they have parked their money somewhere where they can earn 6% retirement savings. Um, so that $8,000, that 10% of your salary, that might actually sound like a lot of money. Okay. Now let's see what happens. Oops. Let's see what Nope, that's not what I want to do. Let's see what happens if I divide that by 26 pay periods. $300 per pay period. Now, maybe that seems a little more manageable to you depending on your paycheck. I mean, this is a scenario. Your scenario might look totally different. But what I recommend doing is taking what it's telling you your total you need to save per year, looking at what it would take to save that per pay period, and then seeing if you can find some room in your paycheck to save that. Maybe you can't find $300 in your paycheck right now. Okay. Maybe that sounds like a lot, but maybe you can find $50. Or maybe you can find the minimum that you could save if you start a 457B account is $20. Get pointed, start saving something now. If it's telling you that there's a gap, save something now. Okay. Then revisit later. Okay. 6 months passes. Do the calculator again. See if you can bump up your savings. See if you can get it eventually up to what it's telling you need to get pointed in the trajectory that you're looking for. In this case, 80%. And I think that you'll find over the time, since you're a new employee or you're in your mid-career, over the time it takes between now and when you go to retire in your retirement scenario, if you continually do this exercise, get the two estimates, plug it into the technology, save what it's telling you to save, you make just little adjustments over time, readjust it every 6 months, readjust it every year. I think that you will find that once you get to the age at which you are ready to retire, that you will have achieved the income replacement percentage that you're looking for. Okay. So that is my spiel on how to do that. There's some more info in here regarding where you can save your money. This is kind of some more info on, saving your money somewhere that has the possibility of earning interest. If you're able to earn interest rather than just saving your money, in cash, it helps you do a couple of things. It helps you beat inflation, which is around 3% per year on average, and it helps you earn more and more money through the power of compound interest. If you look at a compound interest graph, you'll see that if you leave your money invested over long periods of time, you earn a little interest on your money. Okay, then you leave that invested, you earn interest on that money that interest that you already made. Okay, so you're earning money on the money on the money that you're making, and that's why compound interest looks like a curve, and there's an acceleration to leaving your money invested and earning that using the power of compound interest to earn more and more money. It's This is just general knowledge, investment knowledge. The higher the potential for interest, the higher the financial risk involved. So just, be cognizant of that. And then if you want to take an approach where you are investing in a diverse array of investments, and that helps you kind of minimize your risk because you're not putting all your eggs in one basket. You're putting it in 1,000 baskets or 5,000 baskets. The 457B account is a really good place to do that, because you are able to save your money on a tax deferred basis. And so you're able to get a little more juice out of the compound interest thing. And there's a lot of different diversified options in there. Here are some, if you do max out your 457B account or you want to save your money somewhere else, we do have this list. This is out on our website too, of places that are fairly low risk to save additional money if you wanted to. There's more info about that out on that planning page, sarah.org/planning. One thing I want to say is that if you're not an investment person, and you've never really thought about this, there are actually fairly well-written places out on the web that break it down for you extremely easily. One of those places is NerdWallet. Another place is Investopedia. You just type in, like you hear somebody say high yield savings account. Okay, what is that? You type that in, high yield savings account, into Google. NerdWallet or Investopedia are one of the first things that will come up. You can even just type in NerdWallet into the search, and they'll break it down for you super easily. So you can do your own research on these topics. If you need more help, one of the best places to do it is to just open a deferred compensation account, and you get free help as much as you want. Okay. So I'm not gonna pitch that to you anymore. I'm gonna let the expert do that. So there's more info, like I said, at sarah.org/planning. And so at this point, we're going to transition over into the topic of starting a 457B account. Now that you have gotten the two estimates, you've decided, let's say in your scenario, you've decided you do need to save an additional amount of money. The 457B account is a great place to put that money. So At this point, I will turn it over to Gene Hilliard. Gene, are you there?
I am here. How's it going, Mike?
Going really good. Okay, so
Good.
just to introduce Gene, Gene Hilliard is the financial expert that Alameda County has hired to provide this education to you all on the 457B account. 457B, it's kind of like a 401k, but it's for government workers, and it allows you to, it gives you a place where you can save additional money. And if you don't work for the county, because we have 6 employers, 99% of this information is still going to apply to you, and he's still going to do the education for you on this. Um, so I recommend sticking around for this presentation, and we will answer any questions you have. Well, we'll stick around for as long as you want and answer all the rest of your questions after the presentation. Okay. So, Gene, thanks for being here. Go ahead and take it away.
All right, perfect. Well, good morning, everyone. My name is Gene Hilliard. I'm Vice President, Financial Advisor of Emerge Financial Group. We're a financial services company in Oakland. We help our clients with creating wealth that will last throughout their lifetime of their kids and grandkids. We also do taxes. We also take care of accounting for small businesses. Little bit about my background. I've been a licensed financial consultant slash stockbroker for roughly 20 years, helping my clients create wealth. And um, I've also been a retirement counselor. Been doing that for roughly 15 years. When we were hired by Prudential Retirement, now Empower, and the county, roughly 15 years helping all of my clients and helping all of you maintain your current lifestyle in retirement. What exactly does that mean? Well, Mike talked about that earlier. Most financial planners say, hey, you need roughly 80%, 70% of your pre-retirement income. Well, my goal is to help you get to 100%. I want you to maintain your current lifestyle in retirement. Now, if we need to settle for 80%, then so be it. But let's see if we can give it a shot and replace 100% of our income. Now, you guys are blessed. You're in a situation where you work for Alameda County, one of the last government agencies that, or agencies in general, and companies in general, that still offer a pension. So many of you will have a pension through ACERA. You're going to add on top of that Social Security. And that's probably going to leave a gap, but it's going to be a smaller gap than most people. And you can plug that hole, take care of that gap through the Alameda County Deferred Comp Plan. So I'm going to spend roughly 30 minutes kind of going over the plan, as Mike had mentioned, and answer questions that you guys might have at the end. So let's get started. When you're saving towards retirement, it's important to kind of pursue the future that you imagine. What's the plan? How much money will you need? I mean, I know many financial planners, I just talked about 70%, 80%, 90%, but you really want to kind of iron out exactly, if you can, roughly how much you're going to need. And some of these things, these are items that maybe you hadn't really thought about, but I mean, if you were going to travel and retire, most people say that's exactly what they're going to do. You want to ask yourself, well, where are you going? Right? If you're just going to go, I don't know, to Southern California or, to the East Coast, there's a big difference in costs associated with that. So kind of think about where you're going to go. What are you going to be doing in retirement? Are you spending more time with friends and family? Is that what's going on? Do you anticipate maybe buying a vacation home? Kind of give those things some thought. And from there, you can make a determination as to truly how much money you will need. Okay, so let's go through some key topics. I'm going to talk about retirement income. I just mentioned that most retirees will need 70 to 90%. We're going to shoot for 100%. Where will your income come from? I talked about it earlier. You're going to have Social Security. So go to ssa.gov to get a feel for how much you anticipate receiving from Social Security at age 62, 66, 67, or 70, right? You folks don't even have to worry about the provision from the past where your Social Security may be cut because you're a government agency. There's a new law that went into place, Social Security Fairness Act. So you don't have to worry about your Social Security being cut at all at this point. So you're going to get maximum Social Security plus your pension. And then you have your retirement plans. If you by chance have a business or have income property, you'll live off those assets in retirement. If you plan on working a little bit during retirement, which I encourage, maybe part-time, there's nothing wrong with that. Keeping your mind sharp, keeping a routine going with a little bit of work. What I find unacceptable is having to work. But if you want to work to make a few extra pennies, I say knock yourself out. Okay. So what are the benefits of the plan? If you're not in the plan, it's very easy. Money comes directly out of your paycheck, so it's all payroll. So you can't write a check and have that money sent to Empower. It has to come from your paycheck. How much should you contribute? Mike did an excellent job in terms of going through that Vanguard calculator. And he hit it spot on in that most people were going to need about 10% of their salary invested in deferred comp or in some sort of a retirement plan. But typically between 10 and 15% of your pay is optimal. But if you can't afford that, that seems a little cumbersome. Start somewhere, build on that as you navigate your career. Maximums for 2025, if you're under 50 years of age, you can contribute $23,500 a year. If you're 50 and over, the IRS would allow you to put away an additional $7,500. Okay, bringing your total to $31,000. New rule through the Secure Act. If you're 60, 61, or 62, or even 63, the IRS will allow you to put away an additional $11,250 rather than the $7,500. So you can put even more money into retirement to secure your retirement. And then lastly, there is the 3-year catch-up where you can put away $47,000 a year for 3 years. It's only for 3 years. If you qualify for the 3-year catch-up, you don't have to worry about having to retire. That's okay. So if you did your 3 years, you put your $47,000 in there and you decide you don't want to retire, then you just would have to revert back to either the 50 and over maximum contribution, or if you're 63 or 62, you'll have to use that maximum for those ages. Okay. If you're interested in the 3-year catch-up, I would encourage you to reach out to Darnell Williams at acgov.org. He can assist you with determining whether or not the 3-year catch-up will work for you. Okay, some more highlights. Vesting. 100% of the money that you put into deferred comp is yours for you to withdraw once you leave county service. Now, you can't withdraw money while you're currently working, but if you leave county service and you want to withdraw money from your account, you can. That's not an issue. The only way in which you have access to your money is through borrowing, right? You can borrow 50% or $50,000 of your account, whichever is less. The interest rate will be prime rate plus 1%. So prime rate is in the 9% range, or 8.5%. So you'll be paying 9.5% in interest if you borrow from your deferred comp. Now, I know that seems like a lot, but the good news is you're basically borrowing from yourself and paying yourself back. So it's not money that you're giving to a bank, you're giving it to yourself. But I would encourage you to be thoughtful, be responsible when you're borrowing your account, okay? Borrowing from your account. There are roughly 15 investments in deferred comp that you can participate in. There's index funds, there's a socially responsible investment. If you're not interested in taking on any risk, there is the Alameda County Stable Value Fund. No risk, pays roughly 2%. So there are 15 different investments in deferred comp for you to choose from. When you're adding to your account, there are a couple of different tax advantage ways in which you can move forward. You can invest pre-tax or you can invest in the Roth version of deferred comp. Now, it's not a Roth IRA, it's a Roth 457B. Okay. You can invest pre-tax, you can invest in the Roth, or you can roll over money from a previous employer. Okay. But I'm going to spend a little bit of time talking about pre-tax. How does the pre-tax work? Well, you're putting money into the account, you're not paying taxes on the contributions, and the contributions are growing over time. And then when it becomes time for you to retire, then you can withdraw the money, but then the money will then become taxable. The pre-tax version of deferred comp works best if you believe you will be in a lower tax bracket when you retire. So you're putting money in now, you're deferring the taxes, you're paying the taxes later, in hopes that you're at the time you're in a lower tax bracket. So that's the better option. But if you believe you may potentially be in a higher tax bracket, then the Roth version of deferred comp may make more sense for you. And the way that works is you're putting money into the account, you're paying the taxes on the front end, but you avoid having to pay taxes in the future when you retire. Okay, provided that you qualify. How do you qualify? As long as the account has been open for 5 years and you are at least 59 and a half, then the disbursements from the Roth portion of your account is tax-free. Okay, but again, as I mentioned, uh, in order for this to work, it's important, or at least you hope, you're in a higher tax bracket when you retire. Okay, now keep in mind, there is no way for anyone to know exactly what tax bracket you're going to be in. So you do have the option of putting money, investing money in both. You can put a little in the pre-tax, put a little in the Roth. You'll win on one of those sides. So that is an option. However, you cannot exceed the max between the two, but you can invest in both. Okay, here's a bit of a side-by-side comparison. And I kind of went through these scenarios earlier, but just know that if you withdraw money when you retire or leave county service from the pre-tax, it's taxable at whatever tax rate, right? And I'm sure some of you are thinking, well, Gene, you're an expert. What tax rate will I have to pay? And I have no idea because it's based upon your income. Whatever your income is coming from, say you retire, you're getting money from a SARA. Whatever that income is, it's going to be added. Whatever you withdraw is going to be added to it, and then you're going to pay taxes on um, whatever you withdrew from the account. Now, keep in mind also that Empower typically will withhold 20% federal, 3% state, right? So that's just a withholding. That's not necessarily your tax rate, that's withholding. And then you're going to get a 1099 at the end of the year that says, hey, you withdrew this money out of the account, you withheld 20% federal, 3% state. Your tax person will tell you specifically if that 20% was too much or too little. So that's the pre-tax. Roth, you don't have to worry about it. Once you withdraw money from the Roth, it's not taxable. So you'll get a 1099, but it will show that none of it's taxable. So no harm, no foul. Provided again that you're at least 59 and a half and the account's been open for at least 5 years. The other benefit of deferred comp is that your money grows much faster through compound earnings. And how that works is if when you're putting money into the account and it's earning interest, the following year, the principal that you deposited plus the interest earns interest, and so on and so forth. So your money will grow much, much faster. And this is kind of an example of if you were to assume a 6% rate of return and you were to keep that money invested for at least 12 years, then it's going to double. All right. If that same amount that you put into the account earns that same 6% over 19 years, then your money will triple. And the reason why your money is compounding is because you're not paying taxes on the earnings. So the principal plus the earnings or the interest in the account compounds on top of one another. Okay. You're in charge in terms of the investment process, in terms of how much you want to contribute. It's completely up to you. You tell us how much you want to contribute. You tell us which mutual funds you want to invest in, and you can switch that up anytime you like. You can start deferred comp, making contributions. You can stop. Everything is completely up to you. Okay. Now, there are three different, I'd say, types of investors in deferred comp. And you may fall into one of these three categories, okay? You start with a do it for me investor. You want to be completely hands off. You want someone to manage this money for you. Well, Fisher's personalized retirement managed account option is available to you at additional charge. It's roughly 0.62% per year, and they'll do all the work for you. They'll ask you some questions. You'll tell them how much you have invested, um, either in deferred comp or in other assets, how much your house is worth, et cetera, et cetera. They're fiduciary. They'll manage the account for you at an additional charge. Then there's the help me do it investor, right? You don't want to relinquish control over your account. You just need a little help, little guidance. Well, there's two options that are at your disposal. You have Goalmaker. Goalmaker is an award-winning asset allocation tool where you tell us what your investor profile is: conservative, moderate, aggressive. You tell us what year you anticipate retiring, and boom, you'll get a fully diversified portfolio of small companies, medium-sized companies, large companies, etc. No extra charge for that. And then Fisher also has a retirement online advice tool that you can use as well. And then number three, you have a do it myself investor. This is where you're going to analyze the mutual funds that are currently on the platform, and you're choosing. I want 25% in large cap growth Jennison fund, 25% in stable value, 25% in MFS global growth, et cetera, et cetera. You can choose exactly how you want your money to be invested. It's completely up to you. Okay. How do you enroll? Well, if you're not in the plan, I encourage you go to treasurer.acgov.org, click on the deferred compensation tab, print the form. Now, unfortunately, you'll need to print it out. We need a wet signature. Okay. Now, when you get that application, it's a lot of information. You may get a little tripped up, but if you put in your information, you tell us roughly what percent of your salary you want to contribute. You're going to get to the investment page. I would suggest that choose the advisor Goalmaker for now. Choose advisor Goalmaker moderate, and then look for the year you anticipate retiring. So, for example, the models that are the most aggressive, or they're for people who are relatively young, and it goes out to 2040. That's the furthest the asset allocation models go out. So, if you are in your 20s or even in your 30s, then I would suggest find advisor Goalmaker moderate the 2040 fund. Just check that box and keep the ball rolling. Or if you're uncomfortable going that route, then just choose the Alameda County Stable Value Fund, 100%. Just choose that. That's just a cash account. And then you can circle back with me to see or confirm whether or not that was the appropriate choice for you and your family. Okay. If you're currently in the plan and you want to increase it, then go to the same website, treasurer.acgov.org, but you want to look for the payroll modification form and then enter the amount or the percent of your salary that you feel is appropriate. Also, keep in mind, if you are currently enrolled and you haven't made a contribution to your account in 2 or more years, you'll need a completely new application. Can't use that payroll modification form. So If you haven't contributed, if you're in the plan, you haven't contributed for the past 2 years, you'll need a completely new application. Okay. Now, if you're currently in the plan, I encourage you to make sure you have a user ID and password for the website. So create a user ID password. There's a bunch of investing tools, learning tools. There's a online calculator similar to what Mike had shown you guys with through Vanguard. So you can use that calculator to see if you're on track for a secure retirement. So log on to the website, AlamidaCountyDCP.com, create a user ID and password, and use the calculators. Now on this page, if you want to schedule a phone appointment or you want to schedule an online appointment, a virtual, go to the same website. And if you look at the screen, there's that middle picture. It says meet your plan representatives. Click on that, and then you can schedule an appointment with either, either Mark, myself, Dan, or Jose. Okay, so you can go online, or there's the online, or you can give us a call if you prefer, 855-969-4572. Hit option, I believe it's option 3. Hit option 3, and then it will say to speak to Mark Tomei, press 1. To speak to Gene Hilliard, press 2, et cetera, et cetera. So that 855 number will automatically route you to my office. Okay. So with that, I'd love to entertain some questions.